space, because that's where we've got the best positive surprise so far this season. Because after Ultratech, we've seen great follow-up performances from both ACC and Ambuja. Both these companies reporting a very smart improvement in the operating performance. Nigel sums up the details for us.
Well, that's right. The cement majors came in with a pleasant surprise. And if you take a look at it, Ambuja Cements did come out post-market hours, and that's going to get a good reception in tomorrow's trading session. So Ambuja Cements on the top line, that did come in bang in line with what the street was estimating. The volumes really, that was a bit of a disappointment, but that's where the disappointment ends, because volumes came in lower by close to 2%, though we had the realizations come in higher by around 3.8%. The biggest positive, though, was the EBITDA per ton that crossed 1,000 rupees. That's the best reading we've seen in the last 14 to around 16 months. And margins as well at around 23.5%. That beat our expectations by close to around 300 basis points. Power and fuel costs did come in lower. Even on a per ton basis, the power and fuel cost was down by close to around 18%. And the reason for this beat was that they've increased their pet coke usage to nearly around 60% from around 45%. They've undertaken various cost optimization measures. That's what helped them. And also, the packaging costs did come in lower. Profitability as well comfortably beat what we were estimating. ACC, on the other hand, it did come in post-market hours. The stock was more or less flattish by the time we wound up, but that as well was a beat. So on the top line, we did see the realizations did come in lower by close to around 3%. Remember, ACC has exposure to South India. Ambuja Cements doesn't have any exposure to South India. So that's why the realizations were lower, because of lower prices in the south part of the country. Even their sales volumes were down by close to around 1%. But that's yet again where the bad news ends, because the EBITDA per ton came in at around 670 rupees. We were working with a number of around 640 rupees. And margins came in at around 15.5%. That as well looked quite good. Power and fuel costs were much lower. Freight costs as well did come in much lower. On a per ton basis, the power and fuel cost was down by close to around 13%. The key reason being, even over here, they've increased their pet coke usage to nearly around 60% roughly, from around 15 to around 20%. So that was the key reason really why we saw the beat there. Both those stocks, they should do well going ahead, even after the recent run-up, because the numbers looked quite good.